All right, we're live, everybody. So, um, I guess the easiest way is kind of go from left to right. Chris, I know you had some questions. I'll let you kick it off.
All right, great, thanks. Yeah, I had a couple just real detailed questions, and so forgive me if these really sound rudimentary, but revenue hours, demand, sales, we're all using those. Those are all interchangeable, right? I know in different questions they refer to different things, but they're all pretty much the same, right?
Right. It's basically we're trying to get to the cost driver. What's driving that? Assume you're talking. Uh, gosh, what is it? I think we gave you like 100 and oh, well, I forgot the
38 or
number of
39
hours, but
hours.
yeah, 138, 139 hours. Yeah, they're all the same. Yeah.
Yeah, yeah, because one part they mentioned demand, another time they talk about sales, another time they talk about. So I just want to make sure that that was all interchangeable, which is what I
Yeah,
thought.
because the service being provided is in terms of hours, so the demand is hours. Yeah, they're all interchangeable.
Second thing, real technical. Leased computers are on a 4-year run. This has to do more with my back end analysis. Are we assuming that those leased computers, because this thing started in 1993, are almost done, or were they referring to the leased computers have another 4 years left on them? You
I
understand?
have I have no earthly idea.
Only because it matters in my ladder analysis, which is why I was asking.
Yeah, what would it when in the latter analysis? Expand on that a little bit, if you don't mind.
If your computers are leased, right, and they're about to expire, and you end up closing down the division, that's not a big deal. But if they're leased with a 4-year run and it's a $95,000 lease, and you got 40 more years to go, now all of a sudden that matters.
Okay, yeah, I see what you're saying. Just from a horizon perspective there. No, look at it as I mean, just thinking. You're into definitely more detail than intended. The idea there being is the cost fixed, is the cost variable. Does
Right?
that make sense? So I don't have again. I'd have to call that exactly up right now in front of me. But if you look at that lease cost, do you see it variable? And then the horizon, if it's fixed in that horizon, then that's a fixed cost. Um, as far as our decision going forward. So don't try to worry about if it's 2 more years, 3 more years, 4 more years, that kind of thing.
Yeah, that was more on the back end as I was really
Yeah,
feeling. But
yeah.
it's
So you can assume that the horizon we're in, it would be fixed.
it'd be fixed and they're going to expire. So okay.
Yeah.
So on question four, I really got hung up on this one. When you say at the end, it says without reducing income. Well, in our case, it's a loss, right? So we're actually talking about we don't want to spend additional dollars for marketing that would make our loss worse,
That's
right?
correct. That's
Correct. Okay.
correct.
All
That's
right.
correct. So yeah, so you're talking about that. That was the one where we're doing the what ifs, right?
Correct. Correct.
Yeah. So yeah,
Yep.
the last of the what ifs without reducing income, like your marketing budget, basically.
Yep. Cool.
Yeah.
All right. Because you say income, and I'm going, well, it's not an income, it's a loss. So I want to
Loss.
make sure that I understood that.
Yeah.
And then for question three, that's just a what if we're just reducing hours, right? That's all we're doing in that scenario is just reducing hours by 30%.
Read the question to me.
Uh, Reducing operations to 16 hours on weekdays, 8 hours on Saturdays would result in a loss of 20% of commercial revenue. So we're just looking there at if we're going to go off by 20%, right? We're going to decrease by 20%. What does that look like?
Right, exactly. So, I mean, really, the hours don't matter as much. We're just trying to walk through all the scenarios given in the case.
Okay.
So, if the case gives you those scenarios, hey, that's one thing we could do. Well, you go talk to your production people and go, hey, look, if we've cut our hours by this, I mean, don't try to go. I've had people in the past do something like let's try to figure overtime in this and all that. No, just go straight forward, just like the two, the ones right above it.
Okay.
You're gonna have
Oh,
20% reduction in demand. I mean, we're just trying to walk you through those scenarios.
but what about the
Perfect.
variable costs associated with the labor?
Yeah, no, no, that's important because you're looking at contribution there, right?
Okay, okay,
Yeah, yeah. But what I'm saying is you don't have to figure out hour wise.
okay.
Does that make sense? I mean, it's not like trying to say, well, there's so many hours in a day, then this happens. Some people we take that analysis way too far. But yeah,
So
when
that
you're looking at contribution margin, you got your revenue minus your variable cost. Yeah, your revenue is going to change. If your revenue goes up, your variable cost is going to go up. Same thing if it goes down. They're going to move kind of in tandem. So yeah, you definitely need to look at variable cost. Definitely.
but we're only dealing with, I think at one point you said, is literally just the variables that we talked about, which are those three up above, which are the fixed cost of 115, the $28 variable cost, and then the revenue of the per hour. So we're not getting into trying to dissect anything in Exhibit 2 when it comes to question number 3, correct?
You're absolutely correct.
Okay.
Just the ones in the case. Let's keep it. Keep it
Simple.
simple. Yeah, I mean, we're trying to just the idea again, trying to get you to see that you'd have to go to different parts of your organization, obviously, to get that type of information,
Yeah.
right? But you can go say, hey, well, what's going to happen if we do this scenario? What do you predict is going to happen? We predict this is going to happen, then let's predict what the income effect would be. So yeah,
Okay.
just deal with the fixed cost, the variable cost. Again, it's a lesson in cost behavior.
Yeah. Okay.
Yeah.
Those are the only questions that I had. So mine were very detailed. That's all I got.
Awesome.
I need a few softballs there.
Well, I lost sleep over these last night, so they weren't softballs to me.
Well, no, I'm saying those aren't softballs. I want you to throw some to me here. Let's get some easy ones.
Oh, there we go. How about Justin? You're next.
Am I off there?
You are off. Or
Okay.
however you want to.
Appreciate it. Just real quick, question two. It says briefly analyze the cost behavior of the revenues and expenses. You're just kind of looking at for us to look at that and kind of say, okay, they're pretty heavy on fixed cost or they're pretty light on variable, and just a little bit of a analysis of that.
Yeah, I mean that's where it's a lesson on like fixed and variable costs, because what you're going to see, right, the next question, then I mean if you were working with the questions I gave you, it was easier. If you were looking at the questions that like originally came with the case, so I'm saying the questions I gave you, the ones that are on Canvas when you click on the modules. If you look at the ones, if you're looking at the original questions, then what that does is you'd actually have to analyze that. Just go, well, these are fixed, these are variables. How many are fixed? What is the variable cost per unit? And basically, you would come up with your own. Here's total fixed cost. Here's your own variable cost per unit. So yeah, so basically just a real light analysis to say, hey, you've looked at these, you've tried to decide, do we have a lot of fixed, a lot of variable, a mixed, what do you see as a cost structure? So I mean, again, very, very light question, not a ton there, but just it's really to get you looking at cost structure, and then so that we're all on the same page, and honestly, we can have a discussion. Y'all can submit a case without killing yourselves. I can grade one, and then we can look at the feedback back and forth. It allows us to in that next question, I give you the amount of fixed, I give you an amount of variable, just so we're all on the same basis. Otherwise, otherwise we're going to have 50 some odd different cost structures, and there's no way to. If we were having a class discussion, we just sat there for 20 minutes and tried to figure out what was fixed, what was variable, come to some general consensus, and then go, okay, well, starting at this point, let's go forward. Obviously, we're not in class, so that's what I tried to do there.
So you don't need us to list each one?
You can. I mean, no. I mean, a good answer. I mean, a better answer would be, "Hey, I think these are fixed. I think these are variable. We have a lot of fixed, a few variable." That would not be as detailed and good as, "I think these are fixed. I think these are variable."
Okay. So you'd like to see us go line by line and say what each one is?
I mean, you could. I mean, if you can go line by line. I mean, some people will create. I mean, I know some people. I've not looked at any of them yet that have turned them in, but some people will create a spreadsheet and go absolutely line by line. Some may just go, hey, these costs, lump them all together, are fixed, and these costs are variable. So yeah, it's up to you.
Okay.
Yeah.
That's all I had, TJ.
All right. Miss Tara, do you have anything for us tonight? Tara?
I'm good. Just listening.
All right. Philip?
I don't know if you can hear me.
Yes,
through
we can hear you.
It's messing up on me. Well, I didn't have anything in it, but I want to appreciate the last week's review, because that was fantastic. It allowed me to answer all the questions I had. So I'm just sitting in this for educational purposes, learning something new.
And
Hopefully not losing sleep.
No, not. I'm telling you, the last week was fantastic. I love that.
It kept us from doing the wrong questions, which is what I like.
Oh yeah, no, that was. I just kind of assuming everybody was clicking through the modules, and that was, hey, I assumed, so we know what happens there.
Indeed. Galen?
I'm just absorbing knowledge like a sponge.
Awesome. So the question I had, and Dr. Jones, I think, I alluded to it earlier. I'm going to ask you, and I don't know if you can go into this much detail, but on question number, what is it? 3B-4,
Okay.
is the appropriate, I think I have it here, is it revenue minus variable cost minus fixed cost equals income? Is that the appropriate formula to use there?
Okay, well, yes and no, right? I mean, go
Yep.
back and look. Hold on, I'm trying to let me call up those PowerPoints. So I want to call up those because I think you put those up last time, right?
I can do it again if you like.
Nah, yeah, but that might help. That might
All right.
help, so everybody can see it.
Yeah, give me 1 second.
But yes, the answer is yes and no. That is the equation. That's just your income statement equation that everything's going to derive from. Okay, so we will be deriving from that. But when you get those, it's really what's more at the bottom of that. I think it's the bottom of that slide, maybe the next slide. It's beautiful. I've got Office 365 on mine, so it takes like forever to load. We don't have Microsoft people here, do we?
I spent a lot of money with them.
Yeah, so do I, definitely. Yeah, okay, I got mine up. But yeah, it's that underlying equation. So we started off.
Revenue
Yeah, there
minus
you go.
variable
Perfect.
minus fixed equals income.
Yeah, there's your income statement equation, right? And this is where we're talking about that in the lecture, which is really the part that's going to underlie everything. The revenue minus variable cost minus fixed cost is income. That's your income statement. Revenues minus expenses, if you want to lump the two costs together. Revenues minus expenses is income. Then what we kind of, for the math oriented there, what I try to do is break down the items that varied per unit. So the revenue varied per unit, the fixed cost, the variable cost varied per unit. So just kind of a little, I think that's the distributive property, I believe, if I've got the math right. Revenue minus variable cost per unit, isolate those out. Those vary with that cost driver, demand, hours in this case, all those synonyms. So your revenue per unit, minus your variable cost per unit is that contribution. So I think Terry said earlier, are we really concerned with variable cost? Yeah, absolutely. On all these questions, if the revenue is going to go up, then the variable cost is going to go up too. If the revenue goes down, the variable costs go down too. It's not just a change in revenue. So you're looking at contribution. So really, if you really want to look at it, that last equation there is the one that I think is really going to be critical because that's your break-even point. If your X is your cost driver, then it's that break-even point is the one that's going to really when you're looking at the fixed cost. I mean, just don't worry about income. Set income equal to zero. If you set income equal to zero, you have break-even point. So it's your fixed cost divided by your contribution margin. If you and all I did was solve for X, right? I mean, I just kind of I isolated out contribution and solved for X. So fixed cost divided by contribution will give you that break-even point. And if you wanted to turn out, if you wanted to figure out how much is going to make, how much do I need to make $1 million? Fixed cost plus $1 million divided by the contribution margin, then that's how many units you'd have to sell. Now, in the class lecture, we went through a whole like paper mill and paper companies. They're not on the slides because I think I just did that on the. It was easier just to draw all that, and so I just kind of worked it out by hand in the lectures. But that's the point where we use that equation. We illustrated how to use that to get break even, how to get a target profit. We even talked about leverage in there. So yes, long answer to a short question. Yes, revenue minus variable cost minus fixed cost is the equation that you're going to start with, and you can solve everything with that also. But it's probably a little bit easier to use that one at the bottom of the screen there, where you're looking at just fixed cost divided by contribution margin. And then, again, income if you want to set an income target.
Got it. Okay. I'll go back and look at my my math and make sure I'm doing it right. So
Yeah, definitely. And you definitely go back in and look at, that section of the lecture. Again, there's no this is kind of, I think this is the section where we kind of lay out the foundation, the basis of all this. And then in the next section, which is, there's no slides for it, but the next section is where we actually walk through like a CVP example.
This one right here.
Because this is really all we're doing, right? We're using, oh yeah, you got all those, yeah, that analysis right there, where you have the two factories, what is that? Yeah, the lumber companies and the processing the lumber and all that. So that's the one where we walk through what's the break-even point, target profit, factory A, B, and then we bring in leverage and risk there also.
Yep. Okay.
And so really, and that's kind of, if there's one thing that's going to build on, question 3 really builds on, it's applying the CVP analysis idea, right? We've introduced fixed costs, we've introduced variable cost behavior. You see that each one of that this company has a cost structure in place, and then with that knowledge of behavior, we can then use the knowledge of how costs behave in relation to a driver, then to figure out things like, well, what if demand increases? What if demand falls? What if? So all these scenarios that you don't think of necessarily as CVP analysis in general. Hey, we're at a loss. We need to figure out how we can reduce our loss. And everybody has a great idea, but you can put these numbers, if you know what if you can get an accountant to tell you, go in there, analyze your costs. And really it's pretty easy, right? I think when y'all look through that, it wasn't super difficult to ultimately go, hey, I can come up with a, I think these are fixed. I think these are variable. Now, I think most of y'all will know, do we have a lot of fixed, maybe a little variable? You can kind of hint from question 3 what I think as far as fixed and variable. And again, I ignore the intercompany stuff. But if you look at a cost structure, simple cost structure like that, then you can do that with any company. What are fixed? What are variable? And if you get a good assessment of cost, then you can start doing these what ifs. Well, what if this happens? What if that happens? Then you can go to your marketing people or your sales force and go, hey, if we give you X dollars more advertising, what do you think is going to happen to sales? And they go, hey, if we can run these commercials, we can increase sales by X%. That last question, well, okay, if you need these commercials to increase sales by X, I can spend up to this amount because I can tell you how that's going to affect profit. I can tell you if, cost, volume, profit. If I know the cost, I know the volume level, the amount of hours we're going to use, and I can tell you what the profit's going to be. And so all of these are just, A, B, C, D. From calculated break even is basic, but then all of these other ones are just using the same knowledge of behavior to estimate different effects of, possible suggestions of how to solve the problem of the unprofitable segment or unprofitable business.
Okay. That's all I had. I think, did I miss anybody?
We might set a record for short calls.
I know, right?
Sure.
We're getting better at them.
Yeah. Hey, let me say one thing. Next week, I do have something planned for next Monday night. And so can we move this to either Tuesday, Wednesday, Thursday?
Yeah, let's shoot for Tuesday probably.
Yeah, Tuesday worked last time, so I thought that would be good. But Tuesday's definitely good. But yeah, I'm kind of, I should be back, but can't guarantee it. So instead of keeping everybody waiting, it'd be easier to move it if that's okay.
Yep, no worries. I'll send out an update. So, going once. Anybody have anything, Dr. Jones?
Good.
Twice. All right. We're almost done with this accounting class. We only have like 2 more assignments. I was pretty excited to see that.
Yeah, and I don't think what we had. I don't think really there's much due next week. I believe it's the week after. Isn't that right?
It is. Yeah.
Yeah. So next week could be relatively short unless some of y'all get a little head start, and we can kind of give you an idea on what's going on with Dakota, because there's a couple things. If anybody's starting to look at Dakota between
Dakota's
now,
not due till the 18th.
Yeah, the 18th. So it's still some time. But if you start to look at it, again, I will say, I think I put it on that announcement, but look at the module because Dakota's going to get into costing systems. So obviously watch the lectures there that precede Dakota because that's where we talk about all the different costing systems. And in Dakota, I don't want you to design an activity-based costing system. I actually give you one. Again, very similar to this case, tried to simplify the questions a little bit. And so in the modules on Canvas, you are given an activity-based costing system, which is not a horrible system. It's not perfect, but it's not horrible. But at least it gives you a start. And again, same idea as what we just did with this one. Trying to get everybody on the same basis. So if you start off with the questions I gave you on Canvas with that attachment there, I forgot what I called it, but you'll see it when you look at the module. Right, I think it's right under Dakota, indented just a little bit, and that is a kind of a diagram where I've gone in and kind of diagrammed a system for you.
Awesome. Thank you for that. All right, guys. Have a good evening, and we'll talk soon. All right.
Awesome. See you guys next week.
Bye, y'all.
Thank you. See ya.
Thanks.